Tax planning is a little bit like planning a visit to a big amusement park in Central Florida. There are certain expenses that you have as you go that you can't get around. But there are other expenses that if you don't plan for them, they kind of feel like a gotcha. And so today we'll be talking about the basics of tax planning, tax deductions, tax credits, and how you can put together a tax plan that makes sense and works.
So today we're going to be exploring some of the most common tax credits and deductions. But before we begin, we really need to understand what are tax credits and what are deductions and how are they similar and how are they different. So Spencer, you want to dive us in just a brief overview of what tax credits and deductions are?
Sure. So a tax credit is one that reduces your tax bill dollar for dollar, whereas a tax deduction pulls down your taxable income, but it doesn't necessarily create that dollar for dollar reduction. It's usually some fraction of a dollar that you get credit for depending on what your marginal tax rate is.
So let's run through a quick example to show the difference between the two. John and Jane have a total AGI of about $200,000. They take the standard deduction, which is right now about $27,700 in 2023. So that reduces their taxable income from $200,000 down to $172,300. So it's helpful. Without any other tax deductions or credits, their tax bill would be roughly $28,500. If the scenario was the same, but John and Jane had 4 children they claimed as dependents, they would receive $8,000 of a tax credit. So this credit reduces the amount of tax they owe to roughly $20,500. So we see that the tax credit takes a lot more off of their taxes than the deduction does.
But they have that second refrigerator and they're driving their kids all across town. So thank goodness the federal government is helping in this circumstance.
Yes, amen, amen. So Spencer, you want to walk us through some of the most common tax credits?
I will, and as we talk about this, it's interesting because these tend to apply a little bit less to retirees than the tax deductions. So we'll dive in though. The foreign tax credit, this is for retirees who paid or accrued tax to a foreign country or U.S. possession. What typically happens here is you have an investment in, say, a mutual fund or an ETF that holds some companies that are domiciled outside of the U.S. You pay some tax to the government that they are domiciled in for the dividends that you receive, or maybe the interest income if you hold bonds, those kinds of things. And then the U.S. government gives you a credit because you've paid tax to a foreign country there. So you report that on Form 1116. The value varies, but you can't have the foreign tax credit exceed your U.S. tax liability, which I've never seen that happen. I'm sure it could in some circumstances. The second one, that lifetime learning credit, you want to hit that one?
Yeah, so this is really for anybody that's taking classes or improving their skills. So think about a retiree who wants to maybe audit a class at a college or maybe take that woodworking class they've always dreamt of. Now, they have to be from some qualified sources for this tax credit to come, and there are income limitations as well. And the value that we receive is 20% on the first $10,000 in qualified education expenses, up to $2,000 per tax return. And so the calculation, it's a direct calculation of 20% of eligible expenses, and then it's got phase outs as well based on your AGI. Spencer, you want to walk us through the credit for elderly or the disabled?
I will, and this is an interesting one because it applies specifically for caregivers of those folks who are age 65 or older, or those who are on permanent or total disability. So basically, if you're taking care of someone and that is your focus, and there is an expense to that you are bearing, then the government wants to be able to help out. Now, there are limits. There's income limits that you have to be careful with. You file this on Schedule 3 and Form 1040, and the value can range anywhere between $3,750 up to $7,500. And there's some specifics with calculations. You want to be careful on this and probably work with a tax professional as you do this. We don't see this one typically apply quite as much, but if you have an aging parent that does not have resources that he or she can use to support themselves, you want to be aware of this potential tax credit.
Yeah. So we'll move on next to the residential energy credit. And so people who can receive this are if you've made energy saving home improvements, thinking adding solar panels or things like that to your home. It applies only to the primary residence and has specific energy saving requirements. And you're going to report this on Form 5695. And the tax credit is generally about 26 to 30% of qualified improvements. And it's based on the type of improvement that you make, as well as the energy efficient installation. So really there's a variety. Again, with a lot of these, we're going to say you need to work with a tax professional. Talk to your CPA. Don't take these and say, oh, Spencer and Austin had this suggestion. I'm going to go install solar panels on my house and get a tax credit. Go talk to your CPA. We'll say this over and over through this video. What about that next one, Spencer?
So we have the child and dependent care credit. And of course, this one doesn't apply as much oftentimes to folks who are moving towards retirement. It can for folks that are taking care of grandkids or may have other people in their life that they're taking care of. And there's certain limitations in terms of how to file this and what it can be applied to. But it's basically for people who are paying for the care of the dependent so that they can either work or look for work there. And again, the value is based on income levels, but it can be 20 to 35% of up to $3,000 of expenses for one qualifying individual or $6,000 for two or more. The amount there is subject to some limitations. It's not a tremendously high threshold, but the government is giving some credit for those folks who have to pay for the care of children while they work.
Okay, so this next one is the health coverage tax credit. And the intent here is it helps cover 72.5% of qualified health insurance premiums for eligible individuals. And this is specifically for certain trade-affected workers or pension benefit recipients. You're going to file it using Form 8855, and it's calculated based on the actual premiums paid for qualified health insurance. And if you want more information on this, we'll link in the description below an article from the IRS that talks a little bit more about this one in particular. So Spencer, you want to walk us through this last credit that we were seeing?
So the adoption credit, and this would be for folks who have adopted a child in that year. The credit varies based on the particular expenses that are adoption related, and you file it with Form 8839. It can be up to almost $16,000 in 2023. There are a number of different pieces that you have to understand, including that there are income phase outs that can limit or reduce the credit itself. So again, doesn't apply to a whole lot of our clients who are headed towards retirement. For some of our younger clients, certainly may apply there.
We've gone through a bunch of these tax credits. This is an exhaustive list of all the credits that you can get. Just a couple of the ones that we wanted to surface. Now again, the difference between the credit and the deduction is we are reducing dollar for dollar the tax owed with the credits. Let's switch over to the deductions and remind us what a deduction is, Spencer.
So in a deduction, we're just lowering our taxable income. And we have to recognize here that there are standard deduction each year that has been almost doubled basically by the Tax Cuts and Jobs Act. So even some of these that we're going to mention, if they don't stack up and get above that standard deduction, you may have something that could give you a deduction, but instead you choose that standard deduction because it's a higher level.
Right.
So oftentimes we find that even as clients put all of these together, they're not able to get above the standard deduction. So that's our caveat as we get into this section, but it's important to be aware of these different moving pieces because sometimes we can clump these together in a given year and have a better tax plan going forward.
The big thing with that standard deduction is this is going to qualify for the next couple of years as that standard deduction remains high. We don't know if the Tax Cuts and Jobs Act, it's set to sunset in 2026, which could lower that standard deduction back down to what it was before. But for now, clumping these together can be really beneficial if you have high expenses for some of these deductions. So let's start off with medical and dental expenses. And so this one is a little bit convoluted in that it's only the amount that exceeds 7.5% of your adjusted gross income. And that's what's deductible. So first off, you have to have high medical expenses. And then it also has to cross that 7.5% threshold before it even starts to count to itemize.
Right.
So let's say you have an AGI of $100,000. Those first $7,500, you can't itemize.
Right.
So it has to be expenses above that AGI threshold. So, and again, it's only a deduction of a portion of that cost. And you would list this on Schedule A. Spencer, you want to talk us through charitable contributions?
So charitable contributions are the ones that oftentimes we can clump together because if they clump their donations together, they may even take 2 years and perhaps they give in January and December in every other year to be able to clump things together. This gives us probably the greatest source of latitude as we think about tax planning. But the deductions are just for those donations to qualified charitable organizations. We can't give these to kids or family members or what have you. We have to have proper documentation prior to filing the tax return for each one of these. We don't want the IRS to come knocking and then not have that documentation. It is reported on Schedule A. And as we look at these, there are ways that we can, again, clump these together via a donor advised fund or some other strategies that we'll talk through in other videos. But you want to walk us through an example here, Austin?
Yeah, absolutely. So we'll come back to John and Jane that we talked to before. If John and Jane give $25,000 every year and have $5,000 of other tax deductions, their total itemized deduction in 1 year is going to be $30,000. So again, we come back to that scenario. Well, if the standard deduction is $27,700, you're getting marginal benefit by going to that itemized deduction, but it's not substantial. Really, it's going to be a tax savings of about $500. Now, on the flip side, if they had the cash on hand and could do 2 years worth of charitable contributions, and maybe like in Knox County where we live, you can pay your property taxes in October to December in 1 year, but it rolls over into the next year as well. So you could pay 2 years of property taxes together. So if they make those 2 years and then make the 2 years of gifts, that gives them $60,000 of itemized deductions there. And then that would reduce their tax bill by about $7,000. So there's really a pretty substantial impact by clumping these gifts together. So Spencer, you want to talk us through some of those state and local tax deductions?
Well, and these are some of the most contentious parts of the tax law, because what happened in 2017 when tax reform was passed, there's a cap of $10,000 of state and local tax deductions. That didn't apply prior to the Tax Cuts and Jobs Act. So if we see a sunsetting of that law, we'll go back to the old ways in 2026, but we don't know. That would be, if we think about here in East Tennessee, it would typically be your property tax that you would be looking at, in addition to the potential for sales tax, that you're counting. There are different pieces of that in other parts of the country when we think about an actual state tax or an actual local tax that could be in addition to those. But still, again, the cap is $10,000, and there are ways, if, say, our normal tax was $3,000 or $4,000, as you alluded to, that maybe we could double that up, clump them together so that we get a little bit more bang for our buck every 2 years.
Yeah, so the next one we're going to talk about is mortgage interest reduction. So if you've got a mortgage taken out on a primary or secondary home, the deduction is limited on interest up to $750,000 of qualified residential loans. And again, these caps are based on the Tax Cuts and Jobs Act. So again, we don't know where that's headed, but for right now, it's on up to $750,000 of mortgages.
Well, and if you think about it, that if you bought a home for $750,000 and you're paying 6% interest on it, that's a lot of interest, on an annual basis. You'd start off and it'd be close to $45,000, of interest. So it can be still a significant number, but they did put a cap on that was different than what we had in the past.
So you want to take us through the IRA deduction?
Yeah, of course, retirees can deduct contributions made to a traditional IRA if they do not have too much income or have circumstances with respect to their employer-sponsored plans that are in line with what the IRS allows there. So the deduction limits apply based on income and, again, taxpayer or their spouse being covered at work. And that can be a fairly low level if both them and their spouse have an employer-sponsored plan that they can contribute to at work. So oftentimes we're looking at making that contribution through work, through a 401k, 403b, 457 type of plan, doing that for the most part. And then as a secondary option or even a tertiary option, it would be the traditional IRA.
So the next one we'll talk about is gambling loss deduction, our favorite. To the extent that a person has gambling losses, they can deduct it, but it's only to the extent of their winnings. So you can't deduct losses in excess of your winnings.
Right.
So you have to have accurate records of both your losses and your winnings in that gambling, but the deductions can be taken on Schedule A.
Right. So if you blow $100,000 and you had $200,000 of income from work, that's not going to help you.
No.
It's only if you actually had $100,000 of winnings that your $100,000 of losing could help.
Yep, exactly. So take us away with educator expenses.
And this would be, oftentimes if retirees return to part-time teaching or something like that, they can deduct up to $250 of unreimbursed classroom expenses. So this would come out of their own pocket. This is one of those provisions that we recognize that not only do we oftentimes not pay our teachers enough, now we expect them to bring things to the classroom to be able to help with the educational process for students. So the federal government recognized, hey, let's give some benefit, let's give some deduction for that. And so that's up to $250.
Yeah.
Can you walk us through the home office deduction? Because this is one of those that a lot of our clients who are consultants or work from home will often ask us.
Yeah. So if you work from home, a portion of home expenses can be deducted. And again, this is where we would say it's really important to work with a CPA or a tax professional on this, because the office must be exclusively used for business purposes. And really, if you're going to expense it, you have to figure out square footage, how much size of the room is used to know how much of those expenses can be deducted. And you report it on Form 8829 and Schedule C. And so there's a whole lot of caveats to this one that we would just say, yes, you can deduct those expenses for your home office. However, you got to be really careful about how you go about doing this.
So like in our house, we have a music room where the kids mostly play music, play some games. We have a computer in there. Sometimes I'll hop over in there, do a little work, take a Zoom call. I can't use that for home office deductions?
Sadly, no, because it's a multi-purpose room. It's not exclusively dedicated to your home office.
Okay. One of those things that we often get into here are there elements that do not create a tax deduction? And we want to hit some of the misconceptions that we see here. So we'll hit the items that don't give a tax credit first, and then those items that also don't give a tax deduction next. So the first one that we dive into, tax credits. Oftentimes people will say, well, I paid for a grandson or granddaughter's college tuition. Where do I get some credit for that on my tax return? And sadly, we don't get a deduction for paying for college tuition there for, say, a grandchild. Instead, it's wonderful that we have the opportunity to be able to help, but unless they're a dependent, we can't look at that American Opportunity Credit and the Lifetime Learning Credit for paying college tuition directly.
So the next one we'll talk about is buying a hybrid or electric car.
Oh.
And thankfully, this is one that I know quite a bit about because I recently looked at buying a car, which is such a fun thing to do. So historically, there was a tax credit for purchasing plug-in hybrid or fully electric vehicles. Now, the laws are changing. With the Inflation Reduction Act of 2022, there were some changes to this bill, and there are continuing to be new changes that are being updated. So this tax credit was up to $7,500 that you could take, but you had to have tax liability above and beyond that threshold to be able to take the credit. In 2024, I believe it is changing to where you can take it from the purchase price of the vehicle initially. But again, there's income limitations, there are vehicle price limitations. There's all sorts of gotchas here where you really have to be careful if you're going to try to claim this credit. Just because you're buying an eco-friendly car does not guarantee you that credit. So make sure you're checking what are the price thresholds. Is the car built in America? Is the battery manufactured in America? There's a whole lot of caveats to this. So before you start thinking, I can get $7,500 off this car, check with your CPA, check with the IRS website that lists out the cars that are eligible, and then make your decision.
Home renovations, another one.
Yes.
That a lot of misconceptions here. A lot of home renovations don't qualify for tax credits. There are only some that do, as we talked about a little bit earlier. Even those that are eco-friendly, even those that are being pushed by the government, there's a lot of hoops to jump through. So we've got to be very, very careful about what we expect in terms of credits. Now, those are fairly simple. The ones that are mistaken for tax deductions, these are myriad. And we get into these a lot of times with clients. The first one being commuting costs. Folks will say, well, I'm a business owner, or I work in this job and I'm paid as a 1099 employee. Surely I can deduct costs when I commute to and from work. And the reality is you can't, as just this is your office and you commute to and from it.
Right.
If you were going out of town and you were going to another site, then oftentimes that is deductible. But simply commuting back and forth, not a tax deductible expense under any kind of normal circumstances.
Some other things that we commonly misconceive are personal living expenses. Things like utilities, rent, general home repairs for primary residents. They are not tax deductible. even if you work from home and even if you really want them to be tax deductible.
Right.
They're not. Some assume they can be used if they do work from home, and a portion of these costs could be deductible. However, only, like we talked about before, you have to be really careful that the home office is only the home office for those things to be deductible. So what's the next one, Spencer?
Gifts to family. So oftentimes we will walk through a financial plan and we'll recognize that there's some extra income there. And the question arises, well, if I give this to my grandchild or that special niece or nephew, is it tax deductible? And the answer is, if it's to a person, especially to a family member, no, it's not tax deductible. So we have to recognize this. It's great to do that, to be generous. We encourage that. However, we don't get to have any kind of credit or deduction in our tax filing for it. So 4 additional ones that are kind of our bonus section here. First, credit card interest, not deductible, was in a former iteration of tax law. It's not now. Lost or stolen personal property, also not tax deductible anymore after the Tax Cuts and Jobs Act. You have to be in a federally declared disaster area to be able to see any kind of tax deduction for that. Another one that sometimes we get questions about, political contributions, not tax deductible. You may think that, hey, this is really benefiting the nation or benefiting the local area and being involved politically. Wonderful, get involved there, but you're not going to get any kind of tax credit for that contribution. And then the final one is life insurance premiums. Again, an important part of a financial plan sometimes, but not something that you'll get any tax credit for. So with that, hope that that's been helpful. If you have any questions, don't hesitate to reach out to us on any of those. Again, work with a tax professional, CPA, enrolled agent to be able to get your return in order and submitted. And thanks again for joining us.
If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.